are coming in play, the virus's variants, and more importantly, I'm also aware that there is a budget that is due to come out in 5 days' time. But all that being said, I think we are probably on the cusp of repeating the kind of economic boom that this country enjoyed between 2003 and 8. More factors are lined up to have a repeat of that, even slightly better than that, actually. So it's important for us to enjoy the boom that may be coming our way without repeating the mistakes that we did in that boom era and even after that between 2009 and 12, which led to the next 8 years of declining growth rates, bad assets, and lots of corporate scandals and bank frauds, etc. And also macroeconomic instability with lower growth, high inflation for a while, current account deficit, the rupee tanking from 45 to 69 between 2010 and 13, and then now going to 75. So a lot of things happened, and growth rates, even before the pandemic happened, growth rates had declined in the country. And therefore, what is it that we can do this time to avoid a repeat of that and hopefully enjoy a decade-long spell of decent to high growth? So that is the context in which I'm going to speak. So the glass indeed, from my point of view for India, is more than half full, but not without risks, which we will go into. So the first thing I would say is right now in the global space, and particularly in the United States, we are in this fourth turning or the fourth cycle or the fourth innings of a cycle. This is a title of the book by the two authors whose names appeared there. I read this book during the summer of 2020, and I'm quite impressed by some of the forecasts that they made that have come true, including what is going on right now as we speak in the United States. Political and social polarization, not to mention economic polarization, and the kind of disconnect that you see between the main street or the normal average Joe, his or her, his family's economic fortunes, and what is going on in the stock market. So the fourth turning, you can think of it as a fourth innings of a long cycle that lasts 80 to 100 years. And they wrote this book in 1997, and they did say that the decade between 2020 and 2030 will be the final decade of the fourth innings, which according to them began somewhere around 2005 to 2010. So that's quite interesting. You must pick up the book and read the final chapters and the beginning chapters, even if the middle is not entirely interesting. So we are in a very climatic decade in the United States for many reasons. How the United States emerges at the end of it, we don't know. It could still be a superpower, or it could be a power among the equals, or it could be a diminished power like Britain was after World War II. It also coincides, this 80 to 100 year cycle also coincides with a long 250-year cycle, which is the cycle of many empires in the world before Christ and after Christ, the Common Era and the pre-Common Era, the BCE and the CE. So if you download this paper from the internet, and I think it is a good paper, The Fate of Empires, by Sir John Glubb. It's a beautiful paper, just 20 pages. You must read it. And if you look at the fact that the United States got its independence in 1776, 250 years adds up to 2026, and we are in that decade right now. So in general, empires don't last for more than 250 years. So that is the sort of the very macro context I want to set for this discussion. So where are we in terms of the US? Right now, if you look at the election results and what happened there, it also coincides very neatly with who owns stocks in America. The stock market is in a tear over there. Over the weekend, you might have read about a gaming video selling company in shopping malls called GameStop, and then chat forums in Reddit driving many penny stocks to 300 and 400% returns, etc. By many indicators, by many measures, But right now we are in the climatic euphoric state in the US stock markets, and that will have a spillover effect on many stocks around the world should they actually begin to decline. So the stocks in the United States are in general owned mostly by the whites who are college educated, and between the top 20%, they own more than 86% of all stocks. This came out in an article in Wall Street Journal just about 2 months ago in November. So clearly there is a big divide as to who just simply have bank accounts and loan accounts and those who have assets. So that is so clearly the last 1 year, the COVID and the monetary policy or the liquidity that has come into the market, and it's the same in India as well, has benefited a very small portion of the American population. And that exactly is the point that was made in this tweet by Professor Atif Mian in the United States. And he basically says that the richest 1% own 44% of world's wealth, not just in America, but in the global situation as well. So clearly, as the pandemic, unlike the old Black Death of the 13th to 16th century, which in fact heralded the Industrial Revolution because it killed able-bodied men, and therefore wages went up, women came into the workforce, population growth came down even further because the age of marriage got pushed out by 4 more years. And farming with the manual labor gave way to mechanization and also animal husbandry. And because the cost of labor went up, because labor became so scarce, a lot of people died, then it led to mechanization, industrial revolution. But this pandemic has done the opposite. It has driven work home, and in any case has enhanced digitization and made many women in the Western world actually shed their jobs and go back and look after children because of school lockdowns, etc. So clearly, COVID has worsened the labor situation compared to capital, unlike the Great Plague, which did the opposite. Okay. And then if you look at the income and wealth disparities in America, this slide, I hope you can sort of see it. I have given the URL as well. Those making less than $50,000 per year reported the most notable deterioration in their personal finances in 2020 in a survey that came out just couple of weeks ago. And those with the postgraduate degree were most likely to say that their physical health improved in 2020 at a net 23 points. Clearly, even the virus, instead of bridging the divide, has widened the divide, social, economic, and wealth divide in the United States. This is the context in which we are speaking now as to what is going on. And then given the kind of tendency now to raise the minimum wages, probably institute a wealth tax, etc., and economic cycles go around in phases. So 1945 to 1979, post-World War II, the world enjoyed government-led economic development. A lot of government spending, infrastructure in Europe, in the US sent money to Europe, Marshall Plan, all these things happened and helped Japan to industrialize. So basically we had planned development, not just in India, but even in the Western world. There were lots of regulatory institutions that came into existence post-depression, all those things happened. But post-1980, those things became looser and looser. And it was a laissez-faire or a pro-market economics since 1980, including globalization, disappearance of borders for trade, for financial services, etc. But that cycle is probably ending, and the pandemic and the political polarization that is happening could accelerate the return of government intervention and an interventionist economy. So these things are not entirely operating on the basis of the superiority of the ideology. Both seem to take their turns back and forth. It depends on the context. So the context is now setting the stage for a return of intervention in the United States and probably in Europe as well. And that means capital will probably earn lower returns in these countries going forward. And therefore, they will be looking for opportunities in countries like India. And that is why I said the glass is going to be half full for us. So, in fact, that is what these two authors predicted. They said, come the fourth turning, America will no longer be as hospitable to we first lobbies and me first free agents. As the speculum turns, basically a cycle, 100 years, 80 to 100 years, their day will ultimately come again, but not until the middle of the 21st century. Basically, what they predicted when they wrote the book in 1997 was that the free market era that started in 1980 would probably end around 2010, or when the fourth turning ends, which could be at the end of this decade. So it could be another 30 years until 2060 or so before free market ideology makes a return. So we could be prepared for a more activist approach in these countries, sending capital overseas, because domestic returns in those countries will become subpar or mediocre going forward. And therefore, they are entering into the space of activism with debt, inflation, and dollars. So in fact, we are going to have capital flows into India a problem of plenty. If you look at the global debts, they have soared in 2020. Globally, government debt, I mean, not just government debt, all debt, government and the private sector, from 320% of GDP at the beginning of 2020, it just went up by 40 percentage points. And if you look at the emerging markets too, you can say that emerging markets debt servicing costs are going to increase, whereas for developed economies, because they have kept interest rates very low, debt service cost has come down. But it also means that interest rates in developed world is going to remain so low because they have so much of debt. If rates go up, they just can't service it. And that is what happened in 2018. Mr. Powell, the Federal Reserve chairperson, tried to raise interest rates to 2.5%. They couldn't sustain it, and they had to make a 180-degree turn. So like the same situation has become even more magnified right now post-pandemic. The debt levels have gone up so much, therefore interest rates cannot go up. Otherwise, debt will become unserviceable, unsustainable. And that is one of the reasons that we are going to see, like in 2003 onwards, capital coming in. And you have seen that already in 2020. FDI inflows into India, foreign direct investment, was one of the biggest improvements in 2019, even more than China. And secondly, foreign portfolio investor flows into Indian markets in 2020, equity market, has also been extremely high in more than 10 years. So that is clearly already in evidence. And Americans in general, if you can see that, foreigners used to have only about $4.5 trillion of American treasury and private sector debt. That has increased to more than $11.5 trillion foreign holding of American debt. So naturally, when the dollar weakens, the American liabilities are repaid in weaker dollars, and assets held by Americans overseas will improve in value. So net, what I'm trying to say is that whether they say so or not, whether they openly admit or not, America is kind of predisposed to pursuing a weaker dollar policy, and therefore a currency hedging will have to become very important in our corporate situations. In 2013, of course, we had a different problem. The rupee plunged, and many companies were caught out with the no risk management approaches. So in general, that temptation will arise again, because the dollar is going to be mostly weaker and rupee either stable or stronger. Many companies will be tempted to speculate in the foreign exchange market by taking on foreign currency borrowings, etc. So independent directors and board in general have to become much more conscious of risks, because the tendency to forget the lessons of the past and believe that this time is different will once again come back. Human nature never changes. Okay, it just takes a few years or a few months for fear to turn into complacency. And that is where I think independent directors should play the role of what I call party poopers. They have to withdraw the punch bowl when the party gets rowdy. So in that sense, our role in risk management, whether it is in foreign currency borrowing or unhedged exposures, has to be very strong in the coming year and years ahead. So foreign credit to America is actually 60% of American GDP, and therefore the default mode for dollar in this decade is going to be one of weakness rather than strength. Um, and that is the reason why America is trying to pursue higher inflation. But the problem is inflation isn't going to come back unless wages come back. And pandemic, if anything, has worsened the situation for labor. So I don't believe that all these money printing that's happening and Europe, etc., is going to result in high inflation. No, on the contrary, it is going to result in weaker currencies. There is a competition between dollar, euro, and the yen as to who's going to have the weakest currency. And I think America will win this race to weaken its currency. But I don't think inflation is going to be such a big issue, at least until the middle of the decade, until I see the pricing power for workers comes back. And therefore, I don't believe that interest rates in the United States are going to go up anytime soon. As you can see, the 10-year bond yield in America went to 1.12%, but since then has come back by about 10 basis points to 1.02 or 0.3. So I don't see the risk of American interest rates going very higher. And that will be a temptation for many companies to borrow in dollars. So, but beware, we shouldn't overdo it, because sudden appreciation, even if they last for a small period of the US dollar, can catch our balance sheets with pants down. So be aware of that, and therefore inflation will be a non-starter. Interest rates will be low, both in the US and in the UK. So therefore, overall, the situation is American wages will not rise this decade because of the anxiety of the working class, the rise of technology, and post-pandemics did not destroy the working age population, etc. So therefore, this decade in the United States will be marked by two clashes. Socialism defined by anger and rage will be at war with capitalism defined by greed. This is the climatic year. Therefore, maybe by the end of this decade, the dollar may not necessarily be the global reserve currency. But I don't think the Chinese yuan is going to take its place, because United States became indebted after it became rich. But China has become indebted before it has become richer on a per capita basis. So when the dollar's hold in the global economy weakens, there is no obvious candidate waiting in the wings, as America was when Britain was going down. So that is going to create a big vacuum. That is something for us to keep in mind. So the Federal Reserve will keep printing money, and that is what we discussed. So developed countries are going to pursue inflation come what may. Real interest rates in these countries will become negative, as they already are. But inflation in general cannot go up without wages going up. Therefore, persistently loose monetary policies will mean currency weakness and currency depreciation. Emerging markets, therefore, like in 2003, when American interest rates went to 1%, a lot of capital kept pouring into India. In fact, India had a problem of plenty. That is why we made so many wrong investments, which affected us in the second decade. So that history can repeat. So that is the risk factor we need to be aware of. Capital flows into India, for example, as you can see in this slide, 2006, 7, and 8, it went to 6 to 7% of GDP. Okay, so once again, it is going to pick up, and we need to know how to handle good times, because we have suffered the last 10 years of slowdown, etc., etc. Suddenly, we should be not get carried away, and that is again the refrain of my presentation. India, I said the glass is more than half full. The projections made by the IMF for India is that by 2026 March, financial year ending March 26, in dollar terms, India's GDP will be 4 trillion. And in rupee terms, this will be around 3.3 trillion. It will be about 33 trillion rupees. So you can make out that, my apologies, 330 trillion rupees Indian GDP, and in dollar terms 4 trillion. So you can obviously make the calculation that IMF is expecting the Indian rupee to weaken towards 83 by March 2026 in the next 5 years. It may or may not happen, because I believe dollar will continuously depreciate, and if more the Reserve Bank of India tries to resist dollar weakness and buy more dollars in order to prevent the rupee from becoming strong, then we will create the same bubble that we created back in 2003 to 8 in real estate markets. over investments in the stock market, etc. Too much liquidity handling will be a problem for us. It already has become a problem in the last 4 to 5 months. So I would probably think that Indian rupee may end up appreciating rather than depreciating, maybe a bit slowly, but IMF expects rupee to depreciate. I don't think that is a very likely scenario given what is happening in the developed world. Look at the IMF projections for India's GDP growth. They actually think that India's potential GDP growth, the baseline scenario is that it will be around 7%. But if we do prudent fiscal management and undertake economic reforms, the potential GDP growth of the country could rise to 8% by 2024-25. And I think some of the reforms that have been announced already in the last 1 year, I will just name 3 of them. The farm reforms, even though they are under some kind of dispute, the farm sector reforms, decriminalization of Companies Act laws, the labor code, and as well as the policies on government withdrawal except in strategic sectors. These are, in my opinion, could potentially turn out to be very big game changers, as well as the PLI schemes in specific sectors. In the pharma sector, it's already become a good success. And then now we have the telecom sector where India could become the mobile phone manufacturing hub for the world. So given all these things, we could achieve 8% potential GDP growth. And the key is India has never been able to sustain 7 to 8% GDP growth per annum on average for more than 3 to 4 years. We end up immediately experiencing the downside of high growth. Bad debts, currency overvaluation, current account deficit, high inflation, all these things come to plague us. And the corporate sector can play a role in making sure that abundant capital is deployed properly, risk management is done properly. We don't over assume, we don't become over exuberant. So I keep repeating myself, this decade, the role of the boards and directors has to be in advising caution. Right now, it may seem like a far-fetched scenario because we are all still very uncertain. But I am looking ahead for the remaining 9 years. I feel as we go along in 21 and 22 and so on and so forth, notwithstanding what is happening in the developed world, our worlds will become brighter and we shouldn't get too carried away. We should balance return and risk. That is my message. And the second thing you all can do, or we all can do as independent directors. Again, the slide may look very small. My apologies. This is from the RBI website. If you look at the consumer price index data, there is lots of breaks in the data. If you want to compare inflation between 2020 and 1980, you can't. They are 2 different series. So what I'm trying to say is that we have a problem with the quality of data in this country. And to the extent that the corporate sector can extrapolate macro trends based on their own data or based on their industry or sector specific data, we need to make use of them. So data quality in this country, and that is where industry associations, sectoral associations, mobile phone manufacturers, automobile manufacturers, cement manufacturers, steel manufacturers, wherever we can, we should be able to keep pressing the government also to improve the quality of macro data. But also there are some chats coming up that if the presentation could be shared, I'm more than happy to put up my presentation to the IICA and they can display it on the website. I have no problems with that. So the important point is the data quality, data availability, especially long time series, is missing. So companies can do their part A in continuing to impress upon the governments wherever they can in the states and at the center for better quality macro data, and more importantly, using their own results and data, can they continue to improve the quality of macro data available in the country on a timely basis, with obviously due regard for privacy, confidentiality, etc., etc. Because most of the debates in this country on macro questions happen in a fact-free world. We don't discuss on the basis of facts. or data. We discuss things on the basis of emotions or ideology. So data quality has to improve in a big way. And as I said, I'm going to present you evidence as well why the glass is more than half full. If you look at the net FDI, this is FDI coming into India minus FDI going out of India. Net FDI into India has been rising at more than 1.5 to 1.6% of GDP, and it may even go towards 2% of GDP. This is on a net basis. On a gross basis, it's probably more than 5% already. Important point is how do we channelize these FDI? Because usually money goes into sectors that have immediate returns, like consumer electronics, B2C, etc. But it's important on our part to become more productive with the investments that are going to flow in. So how to avoid a boom in the 2020s to be followed by a bust in the 2030s? We shouldn't repeat this boom bust cycle. So prepare the economy to receive and put to use all capital. Remove barriers to investing and growth. Of course, this is more of a recommendation for the government and not for the corporate sector, but in general, it's important. That is what I wrote in my column in Mint yesterday. How can the government get out of the way? Choose the errors we wish to minimize, type 1 or type 2. We have to choose letting go versus leashing in, okay? Financial sector reforms, remove the fear of growing up, because many of our rules and regulations end up becoming more intrusive and invasive as the size becomes bigger. So many people, therefore, many enterprises try to fly below the radar. Okay, and therefore there is we create an unintended perverse effect that we basically do not incentivize our firms and small businesses to become bigger, but we actually condemn them to remain small so that they will stay below the radar. And that is something companies also remember. They have to think long term. In the short run, yes, it pays to remain below a particular threshold because you will escape some stringent regulations and you may also enjoy some interest rate subventions and concessions, etc. But if you take a 30-40-year view, there is an advantage to growth. So in some sense, our horizons in the private sector also have to become broader, bigger, and longer. Okay, so while most of these things are recommendations meant for the government, the last two bullet points is we shouldn't get carried away by exuberance. And while dealing with economic cycles, we must remember this time is seldom different. I will add one more thing actually, which is not in this list, which is that when I see most of the proposals and recommendations that come from industry associations and companies to the government, repeatedly it's about tax cuts, asking for tax cuts, tax concessions, rebates, but very seldom do I see any presentation that comes, any memorandum that comes, which spells out what the corporate sector can do for the country. It's all about asking. There is not much about giving. I'm not talking about money. It's in terms of performance and productivity. Just give you one example. India's personal income tax threshold starts at 2.5 lakhs, and with exemptions, etc., it starts at 5 lakhs per annum. Okay, and the per capita income is 1.3 lakhs rupees per annum. So our income tax threshold starts at nearly 4 times the average per capita income in the country. But in many countries in the world, per capita income could be at $60,000 or 50,000 pounds, etc. But the taxable income threshold starts at $8,000 or $10,000, 6,000 pounds, etc. So the tax contribution by the public begins at a fraction of the per capita income. I understand there are differences, that we have had a high inflation rate compared to the developed world. 7% on an average is 1970s. In a way, the tax rebates become an inflation compensation for the middle class, etc. But even then, our income tax threshold begins at 4 times the per capita income, whereas in many developed countries, the income tax threshold begins at 1/5 or 1/6 of the per capita income. Look at the gap. So in general, we have a tendency to ask rather than treating the obligations of the government and the private sector as a quid pro quo rather than one-sided. Challenges for corporate governance. This is actually what is going on in the Western world. Not necessarily all of it will be relevant to India at this point, but these things have a way of crossing borders and coming over to us as well. So in general, even if you look at the United States, companies do face a challenge. CEOs should stick to what they do rather than getting involved in social issues. That is the overall feeling. 2/3 of the survey respondents said, do you do what is good for you, earn sustainable profits. But 1/3 of the public says they should do other things. But if you look at the younger population, 52% of them think CEOs should be concerned with broader social issues. 48% think they should do what their job is, which is to run the business in a profitable manner. So basically what I'm trying to say is the younger generation is talking about stakeholder capitalism. Maybe the slightly old generation thinks you do what is good for you, what you are capable of doing, which is to run a business profitably. But these pressures will continue to rise in the public debate and discussions. So it is very important, therefore, to be very alive to issues like the employee welfare, stakeholder welfare, whistleblower provisions in the company, etc. If you look at this, trust in the corporate leadership is very low in America. What about India? We need to understand that, in the first part of if you look at the early part of the new millennium, 2000 to 2005, etc., the IT sector was growing very fast after Y2K and technology innovations, offshoring, etc. And the IT sector at that point in time, before Satyam happened, set a benchmark for corporate governance. But in the second decade, it kind of went back towards sort of the old capital and sort of talks of cronyism, bank failures, corporate frauds, all these became once again more prominent. And therefore, we need to ask ourselves, just as these kinds of surveys exist, we need to find out the public sentiment in India towards business leadership in general, and accordingly change our policies and attitudes towards society. We need to find out more information as to how the Indian society views the business sector, the corporate sector. And if you look at this slide here, it says that in general, what are the priorities? The number one priority should be the employees. The number two priority should be the customers. So 40% of the survey participants in the US said employees are 40% priority, customers are 33% priority. So one of the things that directors can do in companies is to exhort their companies to become part of the trade receivables discounting system. That is, if you look at the SME sector, what is their biggest problem? Access to finance. And most of the access to finance problem comes because their big buyers don't pay them on time for supplies. So clearly, the trade receivable discounting mechanism that has been instituted more than 3-4 years ago, but it is yet to gain prominence. So instead of finding ways to delay payments to the SMEs, large businesses must find ways to pay them on time. It becomes, the tendency in general should not be to grab a large share of a smaller pie, but to contribute to growing the pie bigger. Then even a smaller share of a much bigger pie will be bigger in absolute terms than a large share of a small pie. That attitude must be there, and to the extent we can, independent directors must play a part in pushing their companies, even if they are below the threshold that the government mandates, to voluntarily become part of the trade receivables and discounting system. Okay, so my concluding remarks, again going back towards the West, the fourth turning will trigger a political upheaval. It's already happened, and it may again happen in 2024 in the United States. The fourth turning will trigger a political upheaval beyond anything Americans could today imagine, which they wrote in 1997. That's why this book is very interesting. So those guys, obviously, their method was something that worked, because what is happening today validates this sentence, which I found in the book. So given all of that, these societies are going to go through the adaptive valley, which is, things have to get worse before they get better again. Simply put, if I want to summarize this entire 4 bullet points, that is the message. Evolutionary biology tells us that if you know, in order to go from one state to a better state, one often has to go through what we call adaptive valley, a state that is worse. It is only by going through the worst state that we'll actually go through the phase transition. So that means when you are headed somewhere good, it will often look very, very dark. And I'm not saying that this is the darkness, and we definitely are going somewhere that is more positive, but the outcome could also be a disaster. This is not my words, but the words of evolutionary biologist Brett Weinstein. I have given the quote there. So in that case, that is why I feel capital will be looking for options for investments in our parts of the world. And this is the time we need to prepare ourselves to receive, invest, and also to share the fruits of the prosperity that is going to come our way more widely, because a stable society is a sine qua non for a stable and a prosperous economy. But beyond all of this, one last message, and I'm taking the liberty of saying this, is that sometimes when good things begin to happen, we tend to become hubristic or arrogant. But in general, the snowflakes fall slowly to the ground, each flake in its proper place. That is, there is an order in which things happen. Universe determines that order. So when just as excessive fear is harmful, excessive confidence or arrogance can also be counterproductive. So in that sense, we need to remember, for example, none of us anticipated the COVID pandemic at the beginning of 2020, nor for that matter, that after a pandemic happens, the stock market will reach record highs, even when the economies are still officially in recession. So a lot of things are happening which we don't anticipate. So be aware of the law of unintended consequences, and that the road to hell is paved with good intentions. So be confident, at the same time be humble, and do our best to improve corporate governance, focus on risk as the years go by, and make sure that we contribute to improving the quality of data in the country and to making sure that access to finance is available for small and medium suppliers. And as the trends in the Western world go towards more social development and support to the employees and customers, etc., and stakeholder capitalism becomes more important, be aware that these trends will also find their way across borders into countries like India. Thank you very much. This is my presentation is over. The floor is yours for questions.
Thank you so much, Dr. Nageshwaran. I invite questions from the participants. One of the questions is already there, sir, from Mr. Suresh Kumar. His question is, what precautions should we take in view of enhanced NPA due to COVID-19 and potential bubble in the capital market?
No, by the way, this session is not about investment advice, and therefore, even though that's my role in my corporate career, I gave it up 10 years ago. So whatever I say should not be taken as investment advice. So my personal view is that, yes, I mean, when you are in a bubble, it's very simple. The advice is that you normally take your profits and raise your cash levels and become more prudent. That's all. As far as the NPA is concerned, if you are an investor, as far as the NPA is concerned, well, I mean, so far the news is that the corporate sector in 2020 has done quite well. And RBI, I'm aware that in its financial stability report, I once again emphasize, I'm speaking in my personal capacity, has emphasized that the NPA in a stress scenario could rise to 13 or 14%. But given the improvement in corporate profits in general, I'm sure there will be some pockets of vulnerability in the hospitality related sectors, etc. But by and large, as Professor T.T. Ram Mohan of IIM Ahmedabad wrote in the Business Standard last week, barring unforeseen circumstances, I think the bulk of the NPA problem is behind us. It sounds like very brave words, but yeah, we have gone through almost 6 to 7 years of the purgatory, and I think we may be coming out of it, notwithstanding the COVID. So the important thing is, how do you arrest the NPA problem at its roots, which is all about proper pricing of power and water, etc., honoring contracts, and more importantly, when we do projections, when we apply for loans, it is important to have a buffer. Because what happened in 2003 to 8, apart from frauds and many other things, even honest mistakes were made, such as expecting that India's high growth rates will just keep continuing forever. But the truth is, and I wrote this book called Can India Grow in 2016 with a good friend and IAS officer, Gulzar Natarajan. And that book is available for a free download from the Carnegie India website. And most of what we wrote in that book in 2016 still remains valid. So in that sense, I still feel India as an economy hasn't yet fully developed the capability to sustain high growth rates for a long China did. China's growth rate became inferior in quality only since 2008 crisis, or maybe 2 years before that. But from 1980 to 2005, even though Tiananmen Square happened, etc., by and large, for 25 years, China's growth quality was superior. So therefore, I would think we need to develop that capacity. And there, the role is not exactly only with the government, although they have a very big role in terms of getting out of the way the regulatory compliance systems, the tax systems, etc. But we in the corporate sector also have a responsibility to not get carried away by optimism, just as we get carried away by extreme pessimism when things are bad. That is my message about the NPA. So addressing the NPA problem means attacking the roots, which is basically about government contracts on pricing of water, power, etc. And then there are reforms in the banking sector in terms of leveling the playing field for PSU banks and the private banks. But in terms of corporate sector, also not getting carried away by optimism when you make investment projections and when you do the borrowings.
Great, sir. Thank you, sir. There is another question by Mr. Ashok Jain. His question is, post-COVID, what is the biggest challenge to corporate governance in India, in addition to sluggish economic growth?
No, that's what I repeated. The post-COVID, I think for India, it's just beginning to start. I think it is about managing optimism. It may not look that way. And then I mentioned about the trends that are happening in the developed world, about stakeholder capitalism, gender sensitivities. And I mentioned about because as you know very well, the corporate sector has done so well in 2020, even in India. But we all know below the radar, unlisted companies and smaller firms, etc., have probably done very badly. So it's very important for us to find out who among our suppliers is doing badly, what support they need. That's why I said corporate governance is all about basically looking at all our stakeholders rather than only at the shareholders on the bottom line. And that is the corporate governance challenge, because unless we carry the rest of the country along with us, then everybody talks about the K-shaped recovery, etc. That will become a reality. Once a K-shaped recovery becomes a reality and becomes persistent in a country like India, it is actually a big risk against social stability. So the important thing is to make sure that A, the company does well, B, that of such doing well are actually shared.
Great, sir. So there's another question by Mr. Bapi Munshi. His question is, what is your view on how boards should handle climate risk, which is not appreciated well by CEOs and capital owners?
So that is human nature.
It's some distance away.
Sorry, come again?
Most feel it's some distance is away.
Yeah, I mean, that is the usual human nature. I mean, we basically tend to ignore things that are not right in front of our eyes. And that is why even our own personal lives, if you look at a lot of the lifestyle diseases are insidious. They just slowly creep up, and one fine day they flare up. But whereas normal common ailments are right in our face, a simple headache or common cold, etc. But lifestyle diseases are slowly creeping in below the surface, and we don't see them, we don't take action until it's really out there in front of us. And the same attitude applies to the way we think about climate change. But the important thing is, in India, if you look at the RBI reports, monetary policy reports that they produce in April and October every year, they show the mean temperatures in the country rising. And then you also notice that days of extremely heavy rainfall, then followed by long droughts, all these things are so climate change is not just about warming of higher average temperatures, which is also about volatility of rainfall and alternating periods of drought and excessive flooding, etc. The only way we mitigate is whatever that we can do, in terms of contribution to vegetation, farming, or even sustainable practices inside the offices, and also to the extent setting examples in the way we use natural resources, etc. Because this is all about short run versus long run. It is not about green economics being unprofitable. It's a question of what horizon over which we maximize it. Because it is not that when people say in the long run we are dead, but what is long run? Is it 50 years? There? But that is the kind of attitude most of us take. But the truth is, we just don't know when the long run started when it comes to climate change. It might very well be upon us in the next 10 years. So the answer is therefore each one of us spends time or even have some meetings dedicated to this challenge and this topic, and just focus on what is it that we can do, from power consumption to non-cyclable products consumption to many things, and our own contributions, etc. That is the way to think about it. But definitely it is an important risk for the Indian economy because of the rise in sea levels, and India is one of the more vulnerable countries to global warming and rising sea levels. A book written by Ms. Mridula Ramesh, one of the TVS family group's daughter, Mr. Ramesh Krishna's daughter, Suresh Krishna's niece. She runs something called Sundaram Climate Institute. She wrote a book about climate change. One second. The book is called The Climate Solution. The important thing is this book is written for the Indian context. So carbon emissions is not a big issue for India, but other issues are big for India. So it's important for us also not to fall for the Western frame of reference as to what climate change means. For climate change in India, the issues and priorities should be different than what it is for the Western world. So that way, I would personally think, even though I have no stake in this book, she just happens to be a good personal friend. I think this book is very well written.
Mr. Munshi, I think you got the answer. Another question is by Mr. Jayant. His question is, you mentioned financial sector reforms as freedom to grow. But
Sorry?
Could you talk more? You mentioned financial sector reforms as freedom to grow. But could you talk more about the corporate governance in public sector banks, which has to be addressed before you give them freedom to grow, has been the cause of many of the scams in the past? I think question is clear, or you want me to repeat, sir?
No, I think we also have to see these scams in perspective, because it's not as if private sector banks in the developed world have been paragons of virtue. And anything, whatever happened in 2008 in the United States, in the UK, and many countries in continental Europe, those banks were run by the so-called private sector. And they almost brought the world economy to a collapse. So let's be very clear. So it is a human tendency. It is not just something endemic to the public sector. And second, many public sector executives, when they try and migrate to the private sector, they actually end up performing very well. So it is an ecosystem. And that is why for that we have the PJ Nayak committee report that came out in 2015. And many of us have talked about it publicly and privately, etc. So that is why I mentioned this presentation is not about the financial sector, but I did mention that leveling the playing field between the public sector executives and the private sector executives, because public sector banks are governed by the three C's, CAG, CBI, CBCE, etc., whereas they are governed by the Companies Act, because public sector banks are created by the acts of parliament. So many things in terms of the leveling the compliance and regulatory playing field for public sector bank executives have to change first. And we also know, and I think people like if I'm not, Madan Sabnavis of CARE Credit Rating Agency has been a wonderful book, because if you look at the owner appoints both the board in public sector banks and also the executives, then the role of the board in overseeing the management becomes blurred because one person appoints both. So like this, there are multiple changes to be done, and it's well known what needs to be done. It just needs to be done. So providing capital, consolidating public sector banks, they're all important things, and they have been done. And the government has spelled out its timeline to sort of exit from many strategic and non-strategic sectors, which the finance minister said in her presentation in May as part of the Atmanirbhar Bharat Package 1. But we will probably see, hopefully, a clearer and more specific roadmap in the budget or subsequently. But the important thing is PJ Nayak committee report sets out a very good template for what governance changes that need to happen in the Indian banking system.
Right, sir. There's another question. The question is, what explains slightly elevated levels of the net FDI even during 2009-2014, the so-called burst years post 2008?
No, I think if you look at the chart that I showed, the net FDI to GDP ratio in India was never consistently around 1.5%. It has been in the last 5-6 years. So it obviously began to improve after India's high growth years of 2003 and 8, but definitely post 2014, it has improved. That could be due to many reasons. I mean, the Indian economy reached a critical takeoff point and many sectoral rules were liberalized, etc. So it could be due to multiple factors. I haven't studied them in detail for me to pinpoint the specific causes. But the fact is, even in 2020, FDI into India has increased. And part of it could be due to the policies like the PLI initiatives, productivity-linked incentives, etc. And many sectors, including defense, have been thrown open for foreign collaboration and so on and so forth. So that is the reason. And I think, as I said, the first decade was a question of convergence of growth between developed world and developing world. The second decade was divergence again, because developing world didn't do well, not just India. So from 2013 onwards, it was not just Indian growth rates that came down. If you look at the statistics, those countries that did exceptionally well in the first decade actually did quite poorly. Brazil, South Africa, Turkey, Mexico, you name them. And China as well. In fact, the ones that did well were the ones who were still catching up, like Vietnam and Bangladesh and so on. So it is not something that India was an outlier in the last decade. But this decade, we could become an outlier in a positive way. So in that sense, the FDI will pick up. So what happened for net FDI in the last 6 years was a small bright spot, even though capital formation in the economy was slowing down because of the bad debts in the banking system, etc. But the net FDI picked up due to sectoral liberalization and also because of the size of the Indian economy becoming bigger.
Great, sir. There is another question by Mr. Suresh Kumar.
Yeah.
The question is how to have a balanced approach as independent director between society goals at large and organizational goals in view of current political and economic environment.
I think this is, whether it is the current political environment or not, this is always a tricky question. There is no magic formula. There is no one size fits all answer. It has to be on the context because, I'll just give one small thought process that crossed my mind. I don't have the answer to that, by the way. It's a question that comes into my head, but I haven't figured out the answer. In the US, for example, in 2008 crisis, we all said credit rating companies are paid by credit rating agencies are by companies that want to issue bonds. So there is a conflict of interest. Naturally, the issuer wants to get a good rating, and therefore, who loses in the end? The investor. So should the investors be paying for the credit rating? Sometimes it's easy to give conceptual answers, but how do you implement that? Which investor will pay? Because when a company issues a bond, it is bought by funds, insurance companies, pension funds, mutual funds, and also individuals. So how do you pool the money from these people and pay for the credit rating? How much you allocate to which investor? So sometimes conceptually there are easier answers than in practical terms. Similarly, we know that independent directors are appointed by the managements. So are they really independent in that sense? Are they appointed by shareholders or employees and so on? So ultimately, therefore, it becomes a matter of personal charisma, personal persuasion, your ability, your self-confidence as an independent director, and more importantly, the sense of independence or dependence that you convey to the management being intellectually honest and consistent. So that is why I said there's no magic formula for this question.
Some more questions are there, sir. We'll be taking, we have some time. How boards, there's a lot of questions coming, so we have some time.
I'm okay. I'm okay. I can stay on for some more time. No problem.
Great. Thank you so much. Thank you so much, sir. How boards embrace stakeholder capitalism given the pressure of meeting short-term financial numbers?
As you said, correct. Your question has the answer. It's just a question of short-term pressure. It's a question of horizon, obviously. And sometimes you read many times it's win-win. I mean, a company that takes care of its employees and suppliers, you don't know what the quid pro quo is. They may probably become more productive, and in which case you may not suffer even the financial goals when you become more responsive towards the employees and suppliers and society at large, etc. It's just a question of how do you quantify the results. Sometimes you may not quantify it because human beings cannot construct counterfactual scenarios. We are not good at constructing counterfactual. Therefore, we simply don't try. So the answer is you just have to try and do it and then see what the real trade-off is.
Yes, sir. Another question is by Mr. Vineet. His question is, how would the suggested large flow of foreign funds into India flow to the citizen at the bottom of the pyramid?
No, that is not that easy. It's a difficult question to answer. There is no easy answer. Normally, by definition, these monies will go towards established areas where they are looking for returns naturally. And then it's a question of whether that leads to, for example, the IT sector and many other technology companies receive monies. Now, there is a lot of interest happening in financial inclusion as well, in digitization. So directly, there is no mechanism by which foreign investment flows to the bottom of the pyramid. It happens because of higher economic growth. And that in turn raises tax revenues for the government. And that in turn can be channeled into health and education, infrastructure, etc. So this mechanism is indirect and through multiple channels. It's just not possible to directly say because they're not doing it for charity.
So taking the time into consideration, we'll take last two questions.
Sure.
One is, how should be the corporate governance approach unpredictability and inculcate in the culture of openness in future?
How does corporate governance culture, sorry?
How should be the corporate governance approach unpredictability and inculcate in the culture of openness in future?
So, first of all, again, this is a good question for which there are no obvious answers. I mean, there's no. This is matter of practice, and this is a matter of accepting uncertainty, which is exactly in the language of Donald Rumsfeld, the former defense secretary in the U.S. government. This is a question of unknown unknowns, whereas risk is about known unknowns. So, how do you embrace uncertainty and provide slack in your planning? Just as investments at a personal portfolio level should have a margin of safety, the same thing must apply in the corporate setting as well. So when you are uncertain, when things are unpredictable, create a margin of safety. Don't operate at the margin where there is no room for downside surprises. That is the only obvious answer I can give to that question. And therefore, in terms of risk management practices, stop loss level. That's why I said if currency appreciation, I gave a specific example. When you see dollar depreciating, then the tendency will be to think that you can borrow in dollars. But it's important to make sure that you are able to earn enough dollars to be able to repay the loan. So when the currency keeps appreciating for a while, that's what most of our companies did between 2010 and 12. Some of them took dollar loans, and in 2013 they came to grief. So the answer is that when there is unpredictability, it's a question of creating margins of safety.
Thank you so much, sir. Now we are going to take the last question. By Mr. Vijay. This question is, what is your advice to Indian corporate sector keeping in view of global scenario in near future?
That was the whole presentation about. So I think, yeah.
So I think you have responded to all the questions, and thank you so much for handling all the questions so nicely, and your presentation was really very informative and very useful for all of us. On behalf of IACA, would like to thank you that you have taken out your time for us, and I'm sure that independent directors who have attended this session will definitely take use of this and will be helpful in their profession and their role, whatever they are into. Thank you so much, sir.
You're
And I must
welcome.
inform that this link would be shared very soon, this week only. And those who couldn't attend because I'm receiving a lot of messages, so they can also see through this link.
Yeah,
Thank you
I will
so
send
much.
you the presentation. Thank you so much for the opportunity. I enjoyed the session and the questions. I wish you all the very best for 2021. Stay healthy, stay safe, and stay happy. Thank you.
Thank you so much, sir. Thank you.
Bye.
Bye, sir.